Welcome back, everybody. This is John Kirby from the Bear Trap Discord podcast. My co-host is Vic. All chart credits, as always, go out to Auk. This is a Skew special, and I'm talking pretty special because we have around 2 hours of content. I've tried to segment it up for you guys so we have more digestible chunks, around 20 minutes, 3 of them in this first podcast, and then we're going to release episode 4, which has the second half of all this material. Please do share the podcast with as many people as possible, subscribe in whatever form you see fit, and give us feedback. We're always looking for new topics, new ideas, even new charts to create. So we're going to be covering Skew, FOMC, CPI, and then some psychology stuff as well. All right, enjoy, everybody.
We've got this set up here. John Kirby here has set up these charts here just to kind of show us what the difference in skews look like over time and sort of what they're implying. So first off, like, how do you use skew? I mean, just in general, do you use it a lot?
Well, I mean, usually my approach is to understand sort of the theory behind any given indicator so that I can know what's going into it before I try and figure out, how I want to use it, because otherwise you can get crazy shifts like we're going to see in this video, and if you don't know what they truly mean, then all of a sudden all your readings are going to go crazy and you'll think that things are relevant that aren't, and so forth. So
all right, so what is your essentially your general concept or your understanding of what the purpose of the skew is? Like,
yeah, so skew is really just a fancy way of saying we're going to take the implied volatility of every option along the chain, and then we're going to graph them all together, which is what you see here, right? So it's going from, this is obviously just the strike prices from 275 to 450, and then these are the implied volatilities. The reason it says volatility at the mid here is because every option price has a bid and an ask, and the mid is just right between them. So we take the mid price, and then we back calculate the implied volatility from how the market's pricing the options.
And what I love about Auk's charts here is he also shows you the historical IV for different periods. So you see those little horizontal lines. It's kind of hard to see in the video, but you see that. Yeah, there you go. So you can see the historical and the implied. And do you ever use these at all either?
Yeah, definitely. I mean, I think it's a little tricky nowadays, right? So I wouldn't necessarily want to be using, like, I don't know, this IV90 or HV60 because we're in such an intense bear market right now. We know that things are a little crazy right now, or like this week. I mean,
you're saying those are a little lagging, is what you're saying.
Exactly. Yeah.
So you're leaning more towards using like the IV30 or 20 and the HV20 with 30.
Yeah, I think that, like, your understanding of time has to change with the market, right? And like if the market's moving really quickly, then your indicator should move a little quicker too. And that's hard to do, right?
And so then if you're also doing that, then are you focusing more on the skews that are closer to where we are versus, maybe looking out a couple months or looking out?
In general, because volatilities mean reverting, these really far out skews, they have a tendency to look really similar to each other, regardless of the market condition, right?
Right.
Bull market, bear market. I mean, this guy out here is going to look like this guy out here.
Yeah.
It's right. These are color coded. I mean, I think most people can see this pretty intuitively, but and this skew chart isn't particularly important. This is just a random one that we picked. The reason we picked it is because it looks more or less normal, and then we're going to get into some bizarre skew later in the video for everybody.
Right. Yeah. Well, okay. So with that being said, would you say that the further out skews look more normal just because people are taking more positions on the closer dated ones? They're just, people are doing what you're saying is, hey, I'm not even worried about that expiry, right? So it just kind of sits there and looks normal.
I think that's part of it. Another way that I would put it is the further away we are from something, the more it is the case that structural market conditions are going to drive pricing rather than current catalysts. And what I mean by that is people who are buying these puts all the way out in, December 30th, 2022, this isn't even a far out expiry. I mean, if we were going
No.
to talk really far out, we'd be talking leaps and so forth. But it doesn't really matter because you kind of get the idea. So people who are buying those puts, this is sort of portfolio protection territory, right? And it's not something that a speculator is going to be buying.
Well, that's a good point. Hold on, because that's why the skew looks normal here, right?
Mm-hmm.
Because it's sort of like people are just hedged. That's when I see this, I just go, people are hedged. This was my first thought. Because like literally every expiry, it just looks normal because it should be left leaning.
It should be left leaning. And the reason it should be left leaning is because by and large, people use options for protection as insurance. And when people want to go long, they buy stock, which means that there isn't as much demand for options on the upside because not a lot of people are using options to play the upside.
Well,
so that's
and the
what
other
I mean
side of that too, John, is and people are long shares like you're saying, but what are they doing when they're long shares for protection? They're either buying puts as protection or selling calls, right?
Exactly. If those shares are doing well, then they're selling calls, which is why even in a bull market, you end up with a skew that looks kind of like this, right? Where,
well, what happens when they sell the calls out of the money? What's going to happen to the skew?
When they're selling out of the money calls, the skew is going to look even more like this. Like it's going to,
right.
And the reason for it is because, so we talked about implied volatility as sort of this metric for, it's in the name, right? It's like the price of this option tells you how much of a move you would need for that option to be worth money. And so implied volatility, what it does is it gives you a way to normalize the implication of that option for the strike price. Do you think that was clear? Maybe you can clarify that even more.
I would say, whenever I think of the implied vol, it's, it is like that. I want to see a skew like this normally if I want to get long. It can still ride up the left side, but yeah, your implied volatility is simply telling you the range in that time period. You're saying, look, it's going to be able to move in this, in this type of way within this time period. And this is what people are basically pricing in, is a big move. Now, are they always right? Are they pricing it incorrectly? That's where you get into like, okay, guys, we've got one expiry and we'll see some of these later. That's just crazy. And then everything else is normal. Obviously you're not I wouldn't buy into that. You wouldn't want to be long premium into a situation like, so you can start getting into, the market is a little bit dislocated here.
Yeah, and I think what's absolutely essential to understand in order to be able to process those charts, and that's why I was saying this at the beginning, that we want to understand the theory, is because yes, implied volatility is about that. It's about, how much of a move the options are implying, but really it's just a measure of option supply versus demand. These are supply demand curves. It is saying, like, if you look at that 300 strike put right there and you're looking that it's trading at, a 37.5 implied vol, what that means is that there's a lot more demand for that put than there is supply relative to the 325, which is trading at 32.5 implied vol. Does that make sense?
Yeah, it does make sense. But there's the other side of it too, is that, we talked about this too, that the implied vol, way out of the money is higher, right? So I don't think it necessarily means there's way more demand. It just means that it's farther out of the money. You know what I mean?
Yeah, it's sort of, I think these two sides of it are kind of interacting, right? Because on the one hand, it's like there's, I would say that if there were a ton of sellers of those 300s, then the price of the 300s would go down, lowering the implied vol. So it's kind of a combination of two. It's like we have the market structural conditions, which are going to create this type of skew. And then on top of that, we have these supply demand dynamics, which are going to then modify it by, a couple of extra percentage points or something like that.
No, I get it. Yeah. And you can look at it that way. And I would say broadly, you would look at it that way, supply and demand curve. But that's the thing though, is, when you're getting way out of the money and you say even that, that curve out in just December is going to be more normalized, I wouldn't even look at that one. like in this case. But to your point, it makes sense.
I agree. I mean, I think, I think I just realized instead of supply and demand curve, what I should be talking about is, for those of you who've taken, intro to econ or whatever, is just a utility curve. Right? It's like how
Well,
much.
Let's talk about the close one here.
Okay, yeah.
Let's talk about the close expiry here that we're looking at. Like say it's October 5th. Where is that on our chart here?
October 5th is just this top red line
on the left side though. It looks like
oh yeah.
look
It's
yeah,
right
find October 5th.
here. So we were right in this what would you call that? An island formation. Right under the linear regression, the weekly or the daily linear
So
regression.
that's a midpoint of the daily, right? So look at the curve right before the drop on October 5th, October 7th.
Yeah, the drop happened on the 7th.
Do you have skews that go forward?
Yeah, I do.
Let me see the next iteration of this.
All right. So this was yeah, this is October. Let me just double check that date here. Okay, 2020. Yeah, this is the 5th, and then this is the 7th.
So this is the 7th. So this is that drop, right?
Uh-huh.
And let's see, does it show you down there what time you pulled that was pulled?
Yeah, it should. That was 11 in the morning.
Okay. And see how, like I was saying earlier, look what happened to the expiries. What's that one at the bottom? I know the coloring's weird. Can you tell that one that dropped way down? Which is that the closest expiry, or is that October 10th or?
I honestly cannot.
It's hard to tell, I know, but you may be able to tell by the skew on the right.
You know what I'm pretty sure I know what it is. I'm pretty sure that's the one on the 10th. And you know the reason for that would be that just everybody is currently piling into options for the 7th because we're in the middle of a big drop. And so then the demand for these guys on the 10th actually goes down, even though for the next day it's going to go up. So that's definitely what that is.
Well, okay, so hold on. Let me pull that out again, because you can see over on the right, the lower the number on the right side is going to be the higher the skew, the higher the skew, like the higher the left tail. So go to the very right there, into the data box.
Oh, okay, gotcha.
It'll tell you the skew amount, and so you can see the lower the number, the higher the left tail, and so that one's kind of about the same.
So basically what happened is the 07s, for the very day that we were crashing, that skew was really intense. Like that left tail was really high, and then the next two expiries actually got kind of normalized.
Yeah, sort of. They started coming back down a little bit as folks were maybe monetizing. I bet you they were monetizing those dates. And then you had retail and 0DTE buying the 7th.
Yeah, so you get this kind of push and pull dynamic, right? Where if all of a sudden we're having a hell of a move right now, everybody wants to be in the options that are for right now.
And so I want you to look ahead here to the big green candle that everybody got, sort of, most people got kind of off sides with the big gap down and then the rip. So what day is that? The big green candle. That is
October 13th. I hope I have.
Well, real quick though.
Oh, it's right here.
So we're on October 7th here. Go back to October 7th skew.
Yeah.
And then let's see if we can find October 14th skew.
It was 0.123.
And which one of these is it on here, you think?
0.123 would suggest it's pretty flat. I think it's probably either this guy right here or this red guy up here.
All right, so this is what I want to sort of focus on when it comes to looking at the skew, is looking into the next couple expiries, because this is where you're going to be like, okay, we're cratering. You shouldn't buy puts for the most part on a day like this. Like if you're going to continue to be bearish,
you are over. In other words, you're overpaying by let's see, how much is that? Like 15 vol points at least. Right. It's terrible.
And you have way less time too, so that's the other issue. And so there's a really good case if you're going to play directional puts here in this case, then you got to find the expiry that's the cheapest.
Mm-hmm.
Right.
Which is clearly right here.
Yeah. So then you go to that expiry and you go, well, shoot, let me go buy some of these, or you go buy some of the next one up, which isn't bad because if you're paying a little bit of extra points, but you get more time, that's not that big of a deal.
Yeah.
Right. And so that's where I'm using the IV lines as well on the left, because if you're looking at IV 30, or even if the strike at the expiry is below IV 90, well, then that's super cheap, right?
It is. I mean, these guys were insanely cheap at this point.
So you had a situation where the market's cratering. We're probably, let's see, in the middle of the day. I don't know. I don't remember what the pattern looked like throughout the day, if it was just kind of a meltdown, but I don't think it was just like a straight drop. That's probably why you saw some of these expiries dropping off as folks are monetizing them. That's when you get into them again, because you still had the huge drop that came, a couple days later. You still could have played those options. All right, so let's go forward.
Okay, so we wanted next date was the 13th, yeah?
Yep.
All right, let's get this guy. There we go.
Interesting. So whenever I see the frowny face like this, what is this?
You remember what this was, right? You remember what happened on the 13th?
I mean, I know that there was a reversal, but
CPI, dude, CPI.
Yeah. Okay. So this is where I kept saying I was looking at this skew. I remember this, and I was just going, guys, I think it's gonna be a reversal. I did this on FOMC too, but it's like whenever you see this right here, what does this tell you?
Well, all right. So I talked to my buddy who's been a market maker for
Okay, cool.
a little while now. Not a ton, maybe like 5 years or so. But what he was telling me is that when he looks at this, this tells him that how would I put it? That we know, or rather, market makers know that a move is coming, right? Because we're have a binary event, and so the vol right here is being priced really high, but the vol on the tails is being priced less because typically when we have a binary event, we get a measured move of some kind. In other words, it's not an unlimited move, and we know when it's going to happen, which actually decreases risk somewhat on the tails.
Sure.
Does that make sense?
That makes
kind of
counterintuitive.
Sense. Okay.
No, it makes perfect sense. It makes perfect sense.
I think so. What I was just checking was I wanted to make sure that. So we got this that's good. So we got this at 6 a.m., 7 a.m. or so. Okay. So this was the day before the FOMC, which makes sense because that's the shape that we're seeing. What I actually see something a little bit different happening here in the sense that because what's going to happen, right, is that this upside down, this frown has to turn into a smile. Right?
It's going to try to turn into a smirk, right? Yeah.
Yeah. And as that happens, this vol is going to come down, this vol is going to come up, and then this guy's going to stay more or less the same. Okay. So this is what it looks like when the entire market is preparing for a binary event.
Gotcha. Yeah. You're right. They gap it down, and then what happens is the skew normalizes on that gap down.
And that's what pushes us back up.
And that's what you just go, okay, well, everybody's hedged again, or everybody's too far to one side, and then you go higher. Yeah.
And that's why I was saying, if this guy needs to look like this, it means that puts need to get way more expensive, calls need to stay around the same, and at the money vols need to come down.
Yeah.
And that means that we get VIX suppression, which is exactly what we got. And then that actually enforces call and share buying, which is what pushes us all the way up.
And so talk about how the skew is going to come down, and it's going to normalize with the rest of them too, right? So like that's where you get, you're extremely high IV right now versus the rest of the expiries. So that entire skew is going to shift lower.
Exactly. Yeah. And so it's almost like from a visual perspective, you have to imagine that in the passage of time, and this is something that we'll kind of be able to see with our last couple slides or whatever, but with the passage of time, this guy just has to actually mold itself and blend into these. It has to almost fade away, right? Let me fast forward to FOMC because these aren't as important. I was just filling in the gaps for the rest of the month here. 15th, we get back to a normalized skew around here, and then this is, what was this? This is the 26th. we're going to go to the beginning of this week, which is the 31st, Halloween, Monday of this past week. And that's what we were looking like on Monday of this past week. And so as you can kind of see, right, it's like pretty normal in the sense that it's not unlike the first chart that we were looking at, which is this guy, but it's a lot flatter. It's a lot flatter. I don't know what that means. What does it mean for it to be a lot flatter there?
If it's flatter, I always think of as essentially participants, they're either not as hedged because they're maybe a little unsure. And so that's what I always think of. They're not really driving for protection. They're not really hedged, but they're also not really buying a bunch of calls either. And so I would say when I see a flat like that, I just I'm waiting for something to happen.
Yeah, nothing's happening here yet. And so this was the beginning of the day on Monday of this week, right? And this whole week, for context, is about preparing for the FOMC on Wednesday, which was November 2nd.
Let's see where's it on the chart here, which is Wednesday here on the left side.
So this is 10:31, which was right here. It was this doji up here.
Yep. And is this what time of day was this one?
So this is 9:26, and over the course of Monday, what was happening is people were getting positioned, and that's why this is actually also Monday.
Yep.
Isn't that crazy? That's a huge shift in just intraday, huge shift.
And look at the skew. So go back to the previous one there. Is that skew? This was run at 9:26, so that was like right before the open for you.
Correct. Yeah.
Okay. And is that our expiry down there at the very bottom around 17.5? Oh, that's the day before. So okay, it's still showing the day before, right?
Yeah.
It's showing the Friday.
I think we should just ignore this guy.
Oh yeah, ignore that one. So okay, perfect. So our actual expiry is matched up. So this is end of day.
This is not even, because we were pulling it a lot intraday. This is 9:47, right? So this is 15 minutes later.
So huge shift here. Look at the one previous. Look at the one that you ran at 9:26.
Yeah.
Where's our expiry here? November 2nd. Which one is ours?
It should be this guy right here.
All right.
Starting to get some curve in it.
You know what's interesting is that this IV it's normalized like you were saying before. It has come back into sort of its band here, into the the normal distribution.
Yeah, there's HV20 right here.
Yeah, and all of them are in there. So you're going, okay, the market is just kind of chilling. It's kind of equilibrium. That's kind of what I'd be thinking. And then go to the next one. This was like, 20 minutes later, right, into the open.
Mm-hmm.
And people were hammering. Like, I would just think people are hammering calls here.
Exactly. They were like
hammering them. Because even the other skews, even going way out, just the way the smirk looks compared to what you would normally see in a bear market, it's sort of leaning bullish here, like really a lot.
Yeah.
And I would get nervous here. Like I'm going, dude, we're at the top. Like in my opinion, that's what I'm thinking.
Yeah.
First thing.
Well, and I mean, let's break that down because this is all useful things. When we're gonna go and interpret the actual FOMC skew. And so there were two things that you said there that seemed really useful to me and important. One is you look at this and you think they're hammering calls. Why? They're buying a lot of calls. That's going to make the price of the calls go up, which is going to increase the volatility that's implied at the calls.
Right.
And that's what you see. But your trader mind isn't thinking, oh, they're hammering calls, we got to go up. That's not what we're thinking.
No.
What we're thinking is, what would happen if we were to go down? Puts are getting so cheap right now relative to calls.
Exactly.
That's a problem.
Well, you got to think of it like the normal trader that likes to trade reversals, which is sort of like an options trader. In general, you want to, for the most part, you're trying to get a good bet for your money. And this is something that Jem Croissant taught me a lot, is just like, just listening to his podcast, was buy the tails when they're cheap,
Yeah.
and own the tails. Like you don't want to be owning calls here into 45% IV when, 98 days out, the IV is basically down about 25%.
Also, let's talk about this in context. 45% IV on those calls, and I think at this point we had a VIX that was around, like 27, I think, something like that. So
yeah.
the premium that you're paying on, and also IV is generally higher than historical vol or realized vol. So
Yeah.
you're paying a premium upon a premium upon a premium just to buy those calls.
And look where the price is. This is what I always want. This is where you're trying to identify where the FOMO is happening. Look where price is right now on the chart, on the price chart. It's at 390, like 385, 390 is where they opened up and then reversed it.
386.73. Yeah.
Yeah. So folks, in general, this doesn't look like there's funds trying to break us higher to 400 here. It looks like FOMO to me. Like people are trying to play for that 400.
Well, and here's another way to understand that. This expiry looks like this. What do the other guys look like?
Yep. Yeah. So if you look at this, you're going, this isn't a normal investment skew. This is just kind of, this thing is so dislocated. And so like in the chat, I'll always be like, yeah, I don't like the skew here, because it just looks bad. It doesn't look normal. And
are you ready for what happens next? I think this is a good time.
Yep.
Boom.
Yeah. So there you go. And what time was that run?
Yeah. So this is still early. This is 2 p.m. on that same day, right? And this is still in the doji day, right? So we're at, or wait, this is the doji day. So nothing's happening. We still have that mad skew, but remember that was at 45% IV. And think about where this little check mark is. It's down at 34% IV. So you just lost 10 points of vol on those guys.
And so you see what happens is that folks, they're buying these crazy calls, extreme elevation. Everybody's done it. When you first start trading, you don't know any better. So you just think the price is going to keep going up. And even if it stays where it's at, you just lost money.
Exactly. And
like so fast. Yeah. And so the normal trader is going, well, the best bet here is just to sell you the call, right? Because even if it stays here, you're going to catch 20 points on the IV.
Exactly. Yeah.
But it's just like, unless it's just the most insane catalyst of all time about to come, which is like, it never happens.
Dude, I mean, this is an easy calendar trade. So you sell this call and you buy this guy.
Yeah.
And it doesn't cost you very much. And
that's what people do. That's what people do, especially in a liquid index like a SPY. You're going to have all the traders looking at the skew structure, and the smart ones, the ones that you don't really want to bet against because they're putting the odds in their favor, that you don't want to be trying to buy those calls into that. And so if you're not going to buy into it, either you're going to do what? You're going to sit there, or you're going to sell the call.
This is where we want to start. This is how we opened on the day of FOMC. So let's just do FOMC now. And these are super granular. I have like one for every hour basically of the day.
Might not be leptokurtic. I'm trying to think what the actual word is, but yeah, keep going. Sorry.
Yeah, so you can see here pretty clearly, because we're hitting the actual day of FOMC, we have the hump on the most recent expiry, and then everything else is kind of flat because nobody knows what to expect on the other ones. And then we have that same vol structure that we just discussed for CPI.
So look at that IV, man. I mean, if you're sitting here with this, you can essentially almost guarantee you're going to make money if you just buy one of the tails, right?
Correct. Yeah.
And it's either that, or almost no matter what, you could just sell the middle, right?
You could, yeah, you can. I mean, you could have sold it. Basically, the issue with these sorts of events is that there's so much whipsaw, right? You could buy anything or sell anything and make money on it if your timing is good. And if your timing is wrong, the converse is true.
Well, the timing is really just into the event, right? On FOMC, there's the 1 o'clock event, and then there's the 1:30 event when Powell comes out.
Yeah, for CST, and then for EST people, 2 p.m. and 2:30.
Right, that's CST. Yep. And so that's your timing, and then so you don't have to really worry about the timing. You already know that.
In fact, all these vols are going to stay elevated. I guess what I meant is like positioning, right? Because I mean, you could have made money off of both tails if you bought and sold them at the right time. Because we got, I think we under realized versus implied last time I looked on for
What do you
FOMC
mean by
day.
what do you mean by that?
I mean that the options market was implying a larger move than we actually got.
Right. Yeah. So, and that's usually what happens, right?
Yeah.
Isn't there always there's usually, options market, that's why the implied vol is always higher than the historical because, everybody's always expecting a bigger move than actually occurs.
Yeah, I know that because I remember having like 376 puts that I lost like 10 cents on them or something like that.
Mm-hmm.
And so I was like, okay, clearly I overpaid for these. I don't remember when I bought them, but anyway, let me move through these a little bit quickly because it
Okay.
was very cool to see how this skew was changing over the course of that CPI day.
Right.
And I know you called it better than I did. I was seeing, I think, something different than you were seeing. So that'll be interesting to look through.
What do you mean by that?
Okay, so I'm gonna go through them. Da, 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 da. Okay, that's where I started to see something. You see how it's turning into that S shape? It was
Yeah.
an S shape here, and then the S shape went away, and then it came back ever so slightly. And this was right before the event, as I remember. Exactly. This is 157. So for you, that's whatever, 1257.
Right.
Um,
It's so interesting how the market is flat right into it.
yeah, and I took this guy to be indicative. I was like, oh, look at this. And I wanted to trade for that pocket. So I had an iron condor set up to profit off of this little zone right here.
Right.
And then once I saw this skew, I was like, oh man, it's gone. I'm gonna be messed up. And then I saw this one, and that gave me which one? That one gave me hopium, right? I was looking at that and I was like, oh, it could
Okay.
work. And then of course, I did phenomenally at first because it went right into my range, and then the trade got wrecked.
Well, that's the other thing about the price action too, because you can look at the skew, but the skew is going to be very, very delayed too. And a lot of times you gotta, in my mind, I think of well, what is the market gonna do first to really trap somebody? I'm always thinking trap. They're always trying to trap somebody, and it's not really a trap, it's just liquidity grab.
Mm-hmm. Yeah.
And so where is the liquidity gonna be on a flat skew like that? And where are they gonna move it first before the real move happens? And it's typically gonna be in a flat skew like that, it's gonna be up. They're gonna rip it up.
No, you're totally right, and I got faded, right? And I
It's
I can
okay. I
tell
mean,
it.
it's what happens. Everybody gets faded eventually, but it's like, if you're trading for the pin, it's going to be different. And I don't think on FOMC you should ever trade for the pin until maybe all the vol has kind of been worked out,
Well, I know that now, man.
Yeah. Well, and so that's the other thing too is if you're trading for the pin on a high IV day, it doesn't really make a whole lot of sense
No,
unless
you're
it's
right,
really
because
clear.
it's almost like you're trying to stop a freight train with like, I don't know, uh a piece of straw or something. I don't know. Like it's if it's
Right.
moving so fast and it veers off the rails, it's exponentially harder to know where it's going to end up the
Right.
more momentum it has.
Right.
Um,
You're better off waiting until that big explosion happens and then going and selling calls against it.
100%. Yeah, and I mean
Because
you
even
could have.
if it kept melting up, you're still going to catch the IV.
Yeah. Yeah,
And
you're right.
so, and then, looking at it from a standpoint of like, okay, so what are participants doing if skew is flat? Participants don't know what's happening, but IV is pricing at a high move. They're going to move it up into that upper range, which we're already at on a daily.
And
They're
that's
going to
that's
move it up.
exactly what happened, dude. It came right in right
They're
here.
always going to do that. They're going to move it right into that upper range where everybody's retail is essentially max FOMO because they're wanting that breakout. They always want the breakout. And then they're just going to crush it. They're going to crush IV. They're going to crush. Everybody's going to buy puts. The smart money is buying puts or selling calls as usual. That's what everybody's done for 40 years. And they're probably not even buying, zero DTE players are buying that expiration, but I think smart money is buying out into these other expiries.
Absolutely. And what we saw, I mean, skipping ahead a little bit, but what we saw on Friday was the liquidation of those puts that they got on FOMC probably.
Exactly. And so they just sit there and basically, I think what they do is they sit there and they let those FOMO buyers there at the FOMC top, they just get liquidated for the next couple days
Yeah.
because they were buying calls, not just that day, but they're also buying high IV calls on the next couple expiries. And so as those start coming down, let me see the next couple skews on that.
Yeah. Let me break down first. I just wanted to say that the reason I play for this pocket is because these zones where you see that implieds are low, this is where price is probably going to go.
Not if the
Uh,
skew is not left-tailed though.
Not if a skew is not left-tailed.
I always think of like
Correct. Yeah.
price is going to try to go where the IV is lowest.
Yes. Yeah, yeah. That's exactly.
So you're playing for the pocket, like say it was this skew specifically that you were playing for. It maybe wasn't. It was probably a combination. But if it was this one that you were looking at and trying to play for that pocket, it doesn't make sense now in hindsight because the puts were way cheaper. And if puts are cheaper than calls, something's off.
So, okay, but here's why it did make sense.
Okay.
And this is where it gets a little bit less skewy. Um, the so when I was looking at this, I was thinking about okay, we're gonna get 75 bips. I know that already. The market knows that. In other words, after event, it's gonna give us a boost up. So I was expecting an immediate boost up right after the event, and what that would do is if this was already a pocket, it would actually start to kill these puts a little bit more. And then it would almost be like the entire pocket would shift over, and then you'd have something that looks kind of like a U around over here. So I was thinking about how the skew was going to
Oh,
move as the
wow.
event progressed.
Interesting. Wow, wow, wow. Okay, I would have never thought that. So you were thinking, so yeah, on that logic, you're thinking that you're going to create a U around a certain point
Hmm.
as the puts were dying. But why would the put IV as they're dying, why would it create a higher left tail to create the U?
Because this whole thing is going to move down. Um,
I see what
as
you're saying, but no, that still doesn't make sense in this case because look at the further out expiries too.
No, I think you're right. I think this is what I was thinking, and I think it makes no sense. I think you're right.
Well,
Um,
yeah, right. I know what you're saying too. So yeah, but so that's why hindsight's 2020. But yeah, in this case, you can't. I don't think just as a trader, just from my perspective, you can't trade for what you think is going to happen. You can only trade the probability. Okay, if you think the skew is going to end up like this shape in the future, then you're probably wrong, right?
yeah, but
The
that's
only
that's
thing you can bet
also
on is that
that's
the
all.
skew is going to essentially turn into a smirk. That's
I
really
mean,
it.
that's also why you don't buy naked calls here, right? Like that's why I have an IC that's hitting precisely this range, this pocket.
Hmm.
And if I wanted to deploy more capital, I would have had one right here, and then I would have had maybe a couple of naked puts down here,
Well,
or
and
maybe
there
an IC down
and
here.
there it makes way more sense because so now you're getting into where the real smart money and this is just where we're learning, but the real smart money is playing this skew like that
Yeah, because you
because
can you can deploy capital everywhere, which means that you can play all the probabilities along the line.
well, a lot of times what they'll do is they'll go, look, historically, like in this case, historically, IV is super low across the board. And this is something Jem talks about. So all I'm doing is I'm selling calls to finance puts at this point.
Yeah.
Like if you've just got $100 million, you're just buying these puts, like, and you're just it's free. It's free money, essentially,
Well, and if
historically.
you have the capital to wait it out, you're always going to be right, right?
That's what I mean is it's free money at this point for say you've got I'm trying to always think about like what does a hedge fund manager do? I'm like I'm not there, but like if I had $1 billion, I'm taking you know you know half of it in long shares, okay,
Hmm.
a bunch of it in cash, and then I'm taking a 10% of it and I'm just selling calls, buying puts, selling calls, buying puts because it's essentially free.
Yep.
And so at this point, so if you're sitting here looking at this, if big money is essentially thinking the same way I am, they're selling the calls, they're buying the puts for free.
Yeah. No, definitely.
And so that, and eventually what'll happen is if we do get a move down again, then we get that normal skew again, right? Because then everybody else is doing that, and it's just driving that IV up on the left side again, and then you just basically start selling puts against your positions, and continue selling calls against your positions, and just letting the expiries work in your favor, letting time work in your favor. The market is always trying to normalize into a carry trade.
Yeah. So okay. So then, yeah, basically it flattened out, and this is those calls flattened out. This is 12:30 EST. So as we get into the meeting, and it just stayed like that, man. I mean, came down a little here, but this is still really not good for the bull case. Stays not good. That was interesting. This was interesting. This was the one right before.
But yeah, and you see the hedge pressure that went up right into it, but it's still the skew as far as like it's 120% IV here. Okay.
Yeah.
So if you're looking at a smirk, if you just put like a linear regression on there, it's like almost perfectly flat, most likely.
Which tells you it's a problem for the call side because that's not normal skew.
No, and that's the other thing too. It's just remembering where a normal skew should look, just in a normal market.
Let me go back to remind everybody, right? Like, let's look at what normal skew looks like. It's this.
That's a normal like bear market. Well, I would say that's a normal hedged skew.
Yes.
Okay. It doesn't mean you can't ride up to the left side as far as price goes, but every time you try to ride up that left side, as we get closer to the expiry, it's just going to want to come back. It's going to want to come back to those pockets that you were talking about, where you're trying to play these pockets. Look at those pockets there on this particular skew chart. Where are the pockets on the chart?
Right down here, actually.
Yeah, and even further out. So smart money. What are they doing? They're going, look, we got expiries going out into November, and I can basically buy these. I can buy these for 22.5 IV, and I can sell these puts for 35.
Yep. Yeah.
And as time moves on, it's just going to go there. It's just going to eventually go there, as long as this holds.
That's so, actually, that was kind of eye-opening for me, because when you asked like where's the pocket here, I was like right there. I actually hadn't thought, whenever I look at a skew like this, I always kind of thought, oh, there's no pocket, there's no edge to reading this skew, and that's not true. Clearly 400 is the mid price here. Like, it's not the spot, right? But it's the mid neutral vol price,
right?
Kind of.
And it's cheap. I mean, if you think about where VIX is at this particular point, I think VIX is 30 or 28 or something, and essentially VIX is going to try. Well, not VIX isn't going to try, but the market participants, they're going to be playing for these. They don't want to pay. Smart money's not trying to pay 40%. Okay, for puts.
Yeah.
They're not. I mean, unless there's a cataclysmic event about to occur to take us to SPY 275, then, and you can play for that if you want to, but it just doesn't make any sense on a probability distribution. So in my sense now, is the way I think about it now is I play simply every day. I just try to play for the distribution.
Yep.
Okay, because it doesn't. If you have done that for the last 40 years and just played for the distribution, you're killing the market, right? Even if you got blown up once or twice.
Well, and that's what I do in my really big portfolio, in the sense of I wait for us to hit like 1.5 standard deviation, 2 standard deviation on a weekly, 10 period, 20 period lows, and then I sell puts there. And like, hey, I got destroyed on some of my Amazon put sells. I have a CrowdStrike put sell that fell 10% off earnings. And you know what? I'm going to be completely fine, because they're out for December. And at some point between now and December, we're going to revert to a nice little pocket, and then I'm going to just either roll them, or they're going to expire worthless, or whatever. And I don't really have to worry.
Right. And that's the other thing too, is if you're playing for the dimensions, right? You got the time, and then you've got the distribution, right? And so you have all these data points that are edges for yourself. If you combine them, so this is what I've been doing, is combining, okay, I need to know where open interest is. I need to know where the distributions are in the skew. I need to know where the distributions are in the volume profile. I need to know where the distributions are on the GEX.
Yeah.
Okay. And then you start with the edges and work your way in.
Yes, and I think implied vol in that whole, these skew charts in that whole picture, what they're telling you is, if I'm about to go out and make a purchase, first of all, they'll tell you where the market is going to tend towards over time. But sort of on the more granular information is coming from the OI and the GEX and so forth. But if you want to go out and play it, and especially if you want to go out and play it with options, I feel like if you're not looking at skew, you're not looking at, it's almost like you're going shopping online and you're only looking at the product on, I don't know, the brand name website, and you're not checking Amazon too to see if it's cheaper over there. You're not looking for deals.
Correct. And that's all the market is, man. I've told you a couple times now, it's like your job is to look at the market. Like if I hired you right now and I said, look, all I want you to do, I'm going to fire you if you don't do this, is just go look at the market and just essentially try to make it efficient. Right. Be as efficient as possible with the money. I don't care what it is.
Yeah.
You know, just go in there, and your whole job, the only way you get paid is essentially just to play the distribution and just play it as efficiently as possible.
No, that makes sense.
And so when you look at a skew like this, a normal investment skew, it's just going to be like, okay, yeah, we might not go to 400, but every time you try to push to the left, every time spot tries to drop, that's just going to be more and more fuel to rip it back up again.
Yeah.
Because as those tails down to 275 and to 300 and even 325 and 350, as those tails start to go out of the money based on time, as the essentially the delta curve shrinks, you know, that's just going to be way more fuel for people to start covering.
Let's put it this way: as price moves lower, it has steeper and steeper to climb to go down.
Exactly. Yes. As you're climbing up, it's going to be harder and harder for participants to pay money for protection.